In this video, we are going to take a look at the 10 rules that Warren Buffett lives by. Born in Omaha, Nebraska, Buffett is worth $84 billion today and is considered as the greatest investor of all time. So let's begin with rule number 10. In the world of business, the people who are most successful are those who are doing what they love. Warren Buffett simplifies one rule that is required to do anything. You must love what you do. If you don't, success will be a hard thing to find. He often takes investing as a game and enjoys every moment of it.
The important thing to do is to look for the job you would take if you didn't need a job. And life is wonderful then. I mean, you jump out of bed in the morning because you're really looking forward to the day. I have, for over 60 years, been able to tap dance to work just because I'm doing what I love doing. And I just feel very, very lucky.
Rule number 9. Anything can happen. Buffett always believes that anything can happen in the stock market. Nothing is impossible. It is important to analyze the company you are planning to invest in thoroughly.
You can see this. I went down to the South Omaha library, and I think for $1, I got 7 copies of old New York Times from big times like the Panic of 1907. This is one, 1929, obviously. But I wanted to put on the walls days of extreme panic in Wall Street, just as a reminder that anything can happen in this world. I mean, it's instructive art, you can call it.
The only person that can cause you to get a bad result in stock market is you. Majority of the people fail in the world of stock market simply because they don't analyze the companies that they are investing in.
I never know what markets are going to do. There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it, and I've never felt that it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
You know, I know you look at things like that, but I also know that you look at stocks and try to decide if they're fairly valued, if they're overvalued, if they're looking cheap at this point. And we have been waiting for a correction for an awfully long time. That's finally come. Do stocks look cheaper to you, just based on where we've come?
Well, anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy. But stocks are going to go down. You could probably look it up as to what percent of the days of since I was born they've gone down, and maybe it'd be 30% or something like that. And you can't predict what stocks will do, but in the short run. But you can predict that American business will do well over time. And just take the 20th century. Stocks went from 66, the Dow average, 66 to 11,497, and you were getting 3 times as much in dividends as the whole average was selling for at the start. And you had 2 world wars, and you had a Great Depression, flu epidemics, all kinds of things. American business will do fine over time, and if you own a piece of it, and if you don't beat yourself, the only person that can cause you to get a bad result in stocks is yourself.
Next in the list, we have the Evergreen Rule in the world of investing. Patience. Patience seems to be a common quality of many great investors. Buffett makes it crystal clear that if you have analyzed the company you want to invest in, you should be confident about it and wait for the results to come.
I mean, you lay this out in the annual report, but a lot of investors are told, retail investors are told, that they should have a certain percent of their portfolio in bonds. Maybe they're told 60-40, maybe they're told 70-30 stocks to bonds. That's something that you should do, and that's the safe way of doing it. What are they missing?
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because a stock goes down, you shouldn't own a stock at all. No, I mean,
what are dumb things? Selling a stock because it
yeah,
goes
selling
down?
a stock because it goes down. I mean, if you buy your house at $20,000 and somebody comes along the next day and says, I'll pay you 15, you don't sell it because the quote's 15. You look at the house or whatever it may be. But some people are not actually emotionally or psychologically fit to own stocks. But I think more of them would be if you get educated on what you're really buying, which is part of a business. And the longer you hold stocks, the less risky they become.
Moving on to rule number 6. You are buying a business. The difference between Buffett and others is that the others are looking to buy profitable stocks, whereas Buffett is always in the search of profitable businesses that have a moat around them.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high. But prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
Okay, so now you're familiar with the rule number 6. Next in the line is the rule number 5. That is, understand the business that you are buying. If the business does well, the stock will eventually follow. Understanding the business model is probably the most important requirement for investing in stock. You must understand how businesses earn their profit and how their management works. Don't judge a business only by its stock price.
You don't really understand the businesses that you own. On a personal portfolio basis, I own one stock, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to, have proper diversification, be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies.
Rule number 4 on this list clarifies the fundamentals of stock market as well as human life. If you buy things that you don't need, you will soon sell things that you need. He never buys what he doesn't need. His investing strategy is very well planned and only includes the companies that can turn as a fruitful investment for him. Now let's move on to the top 3 rules in the list. These rules are the basis on which the career of Warren Buffett and Berkshire Hathaway stands on. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price.
Charlie Munger has had a big impact on me in moving me toward looking for wonderful companies at fair prices rather than fair companies at wonderful prices. And that was enormously important because it enabled Berkshire to scale up in a way that would have been impossible to do otherwise.
Rule number 2 is Circle of Competence.
Ted Williams wrote a book called The Science of Hitting, and in it he had a picture of himself at bat and the strike zone broken into, I think, 77 squares. And he said if he waited for the pitch that was really in a sweet spot, he would bat 400, and if he had to swing at something on the lower corner, he would probably bat 235. And in investing, I'm in a no-called strike business, which is the best business you can be in. I can look at 1,000 different companies, and I don't have to be right on every one of them, or even 50 of them. So I can pick the ball I want to hit. And the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing you bum, ignore them. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. Over the years, you develop a lot of filters. And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle. Defining what your game is, where you're going to have an edge, is enormously important.
Topping the list are the 2 golden rules of investing by Benjamin Graham, the rules that shaped the career of Warren Buffett.
Rule number 1, never lose money. Rule number 2, never forget rule number 1.
So which rule do you agree with the most? Tell us in the comments below. Also, which investor should we cover next? If you like this video, give it a thumbs up. Subscribe if you would like to see more videos like this. Tap the bell icon to get notified whenever we upload a new video. Till then, check out the NiftyTrader app, and you can also visit www.niftytrader.in for all-in-one technical analysis. And as always, thanks for watching.